As we look forward to 2025, I think that the fundamental visibility is much better than it was at the start of 2024, meaning we have a Fed that's dovish, and I'd consider that, a Fed put. We have the election behind us, which was really a source of angst in 2024, and the incoming president is very pro equities. So I'd call that a Trump put. That's a tailwind. We know businesses have been cautious for the last 2.5 years because of the combination of the pandemic and the repercussions on the labor force, plus the inflation wave, plus a Fed that was trying to quash inflation. So I think animal spirits return. So these are the tailwinds that are positive for equities in 2025. But the drawback in our view, or the headwinds that emerge, is one, there's a lot of promise about potential initiatives in 2025 that I think become markets have to reckon with it. I think that comes in the second half. There is also a valuation. The stock market is more expensive than it was 2 years ago. So the markets may be a little less patient if there are any stumbling blocks. And the third risk, in the second half that emerges is that there are things that markets will start to worry about, like deficits and the potential ending of the business cycle in 2026. So I think that those are the things that weigh on markets in the second half.
It's almost like there's all this optimism happening, and then it sounds like at some point next year, reality is going to set in. And the thing that you mentioned there is, a lot of optimism around initiatives. What kinds of initiatives are you describing there? I assume these are Trump policies that the market is expecting will boost the economy in some way.
Yes, I think some of the initiatives have a lot of positive potential. Others carry with it risk. On the things that carry risk is how the economy will be affected by mass deportations if that happens. The notion of tariffs. Tariffs can be an important tool, but tariffs can be very disruptive to a global economy. And then there's also DOGE, the Department of Government Efficiency, that I think if we were in a crisis moment, DOGE could be extremely effective. But at the same time, tackling government spending is something that I think is extremely difficult and fraught with visibility risk. And I think it poses risks for companies that are big government contractors. So that's what we have to watch. And then the other thing I think that really bears watching is Bitcoin, because I think there is a lot of policy that's being built around Bitcoin finally being more accepted, the sandbox changing for Bitcoin to be something that the US government potentially embraces.
Today, the spotlight focuses on Nvidia, a behemoth in the technology industry that has, once more, magnetized the market's gaze. Surprisingly, this attention isn't due to a groundbreaking gaming console or an announcement about a cutting-edge sci-fi film. Instead, the excitement is rooted in something considerably more exhilarating: the delayed release of Nvidia's highly anticipated Blackwell artificial intelligence chips. Such developments send ripples through the corridors of investor networks, weaving a complex tapestry of both eagerness and unease. Industry observers, including Piper Sandler's harsh Kumar and Barclays' Venu, Krishna, are zeroed in on this unfolding narrative as Nvidia ostensibly steps into the so-called tech penalty box. But true to Nvidia's unpredictable nature, the company's technical charts could easily veer off the expected path, thrilling both skeptics, envisioning sharp declines, and optimists foreseeing meteoric ascents. Join us as we delve into this gripping stock market narrative that promises both intrigue and drama. Welcome back, everyone, to Investocracy.
Let's welcome in Tom Lee now. FundStrat's head of research and a CNBC contributor with us, as you see, at Post 9. Welcome. It's good to see you.
Great to see you.
Let's hit tech first. Should we be surprised at this resurgence, this melt-up? And it's maybe caught some people by surprise.
I think investors should realize 2024 has been a year of surprising strength. The market has avoided so many opportunities for weakness. And now we're entering the final weeks of the year where we know there's still $7 trillion of cash on the sidelines. and quite good visibility in next year. So I think stocks should finish very strong.
Why do you think money is going to the mega caps now in the manner that it is? Up 1.75% today, the NASDAQ up almost 4% over a month, and able to achieve this milestone.
One reason is mega caps have been leading. So it's sort of what people reach into the shelf when they're risk on. But second, we know that when interest rates fall, the mega caps actually are very sensitive to that. And I think today was a day where the odds of a December cut increased. The probabilities are now solidified, and that's actually bullish for tech.
Because the CPI was, some would say sticky, but it was largely in line. Is that how you read it?
Yeah, that's right. And I think it's allowing the CPI print today allows people to imagine a path to 2% because shelter now is cooling to a level that's in line. Auto insurance, which was at 25% earlier this year over year, is now down to 13%. So the two biggest contributors to CPI are in a downshift. I don't think the fact that used cars are going up is going to reverse the Fed's view. I don't think the Fed's going to tighten because used car prices are up.
All right, so Fed's cutting next week. That's your base case?
Yes.
And then what happens after that? All bets are off? Wait and see? What do you think?
I think the Fed put remains in play because neutral is, let's say, 2.5% to 3%. We're at 4.5 after the December cut. So we know the Fed's in a cutting cycle. I actually think the best case is for the Fed to do the fewest number of cuts next year.
Step into the vibrant, ever-dynamic arena of the stock market, where Nvidia's ongoing saga is the centerpiece of lively discussions during Wall Street coffee powwows. Nvidia finds itself entangled in the complicated dynamics of its postponed Blackwell AI chips, a saga that's captured the imagination and anxiety of the market. Witness the passionate duel between two entrenched camps, the bullish proponents, confident and brimming with optimism, and their counterparts, the bearish critics, stewing in apprehension. Savvy investors need only cast a glance toward the 20-day and 50-day moving averages to appreciate the unfolding drama. Nvidia's recent dip beneath these pivotal technical thresholds has sparked a whirlwind of speculation and debate. Visualize the scenario with a dash of humor. Why did the trader bring a bar of soap to the bank? To cleanse his stock options. Yet in all seriousness, while short-term fluctuations may invite corrections soon, Nvidia's enduring upward momentum remains solid, supported by its position well above the stalwart 200-day moving average. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
That means the economy is pretty strong.
That's right. It's strong. They're not harming the economy by keeping rates here. And the labor market is holding up, and now we have a lot of firepower for future cuts, which support stocks.
Okay, you talk about a Fed put. You also talk about another put, and that's a Trump put.
Yes.
He's going to be here tomorrow, by the way, ringing the opening bell. People are excited about that down here for sure. But you say that that is a substantial part of your outlook for the new year. The Trump put, explain.
The Trump put is, on the simplest level, it is a White House that is going to measure its success by how the stock market performs. But it's also a president that's coming into a second term, but with a lot of previous experience. So this is a cabinet that has good private sector acceptance, and I think very markets friendly. Overall, I think investors who might have been cautious for the last few years now want to be risk on next year.
All right. So your outlook to me is interesting, the way you sort of game out where the S&P can go, because you say we're going to 7,000 by mid-year, which sounds amazing because most targets that I've seen are 7,000 at the top end for the entire year. Your full year forecast, though, is 6,600. Why?
Part of it's cyclical. We're coming off two back-to-back 20% years, and there are 5 precedents to look at. 5 of the 5 precedents since 1880 had a weaker second half. So I'd say that's the base case. The reason I think markets do better in the first half is that there is going to be a lot of enthusiasm about a new White House, some of the headlines that come, whether it's deregulation, et cetera. And we know there's still a ton of cash and a lot of low leverage on the sidelines. That's why stocks can rally. And by the way, 11% in a few months, we've seen that routinely the last couple of years. But in the second half, I think markets start to worry about the larger macro risks like the Middle East, the potential risks of tariff and executing that, and potentially the fact that Doge could be so successful that it could slow the economy.
You're worried about being too efficient, cutting too much, and what the impact is going to be?
Refocusing on the weekly candlestick chart reveals an entirely different narrative. Contrary to the daily ebbs and flows, the prolonged perspective points towards a decidedly optimistic outlook. Ironically, the hobbling 20-day average often serves as a clarion call for vigilant investors looking for a dip-buying window. Even as the much-anticipated Blackwell chips remain on the horizon, Nvidia might find itself momentarily tripped up, yet far from out of the running. The so-called penalty box, a term coined by Krishna, is not so much a confining cage but rather a sanctuary for strategic recalibration before a potentially forceful comeback. Supporting this forecast are the comforting affirmations of analysts who confidently maintain that demand for Nvidia's technological solutions will not wane. In fact, they predict a fervent future. Even with Blackwell's delay, prognostications extend Nvidia's revenue-enhancing tailwinds well into 2025. This timeline, rather than provoking panic, calls for strategic patience, which seasoned investors may find rewarding. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
I do think there's still a lot of upside. I mean, small caps trade at 10 times median forward earnings. I mean, that's a...
So what do you think that should be, 12 times? I mean, what's the opportunity set in your mind?
Well, since 1987, small caps traded on a median PE basis at a premium to the S&P. The S&P is at 17 times. So I think small caps could, in the next couple years, outperform by more than 100%.
And what do you think about some of the macro issues that I think create a different level of uncertainty? We keep talking about the bond market and what that might be saying, what you think is happening with gold. Are the bond vigilantes going to be this governor on whatever you think is going to happen in Washington?
As James Carville famously said, the bond market is, everyone's scared of the bond market. So that is something we need to watch. But we've had plenty of periods where stocks have risen with bonds rising. And I kind of agree with Powell's assessment that it's not yields have gone up not because of inflation, but because there's sort of a change in growth expectations.
I thought that a sweep was, for either party, was the death knell for the markets and frightening to all involved. And now we're getting a sweep. Why isn't it more frightening? Maybe the sweep the other way would have been a little more frightening to some.
Yeah. I mean, I think part of the reason investors are getting somewhat optimistic is that President Trump is entering office again, but this time with a lot more knowledge of how to build a cabinet and a team. And so in some ways, this would end up being more market friendly. And I think that's why investors are becoming optimistic. I mean, I kind of agree with the idea that there are animal spirits growing.
He'll never be deficit friendly, will he? I mean, he will be deficit friendly. He won't be, if we cut taxes on tips, Social Security, overtime, remove the SALT cap, extend the tax cuts. If you do all those things, that seems like...
It's going to be very difficult to fix the deficit with just changes in taxes and spending. But it's probably why Bitcoin is kind of interesting here, because it's potentially a treasury reserve asset. And, if Bitcoin rises in price, it actually helps offset the liabilities, which is the deficit.
So you were at 150, I think, on Bitcoin, weren't you? But
yeah.
Not necessarily by the end of this year, or?
I think 6 figures is still possible before the end of the year, yeah.
And then more next year and the year after?
Yeah, I think because now, post-halving and now Bitcoin's becoming a lot more relevant, and I think maybe the regulatory overhang is diminishing, that there's a lot of upside from here, yes.
Okay, S&P, end of next year.
Well, between now and year-end, 5 to 10% is probably the base case, just because that's the type of rally post-election, and we have a dovish Fed and, the normal seasonals.
Is that the right move right now for the Fed?
I think inflation fighting war is largely over, and the real rate is still too high. So I agree with Fed's view that we need to move towards neutral, which is towards 3%. So I think it is supportive of markets, and business investment has been constrained. So I think these things are positive.
Yet the proverbial $64,000 question lingers. Does the current Nvidia stock downturn signal a prime investment opportunity, or does it serve as a cautionary tale urging restraint? Nvidia's cyclical journey from peaks to troughs suggests significant volatility, synonymous with both risk and potential reward. As speculative excitement mounts over the postponed Blackwell chips and enduring long-term growth indicators reveal themselves, Nvidia's narrative conspicuously hints at substantial growth prospects. For those investors perceptively watching Nvidia's maneuvers, now could be the ideal moment for strategic positioning, ahead of growth projections transitioning from speculative forecasts to concrete outcomes. As Nvidia gears up for its forthcoming upward trajectory, the stage invites contemplation. Are you ready to embrace this opportunity in tech's evolutionary landscape, or will you spectate from a distance, a leisurely coffee in hand, waiting for the charts to elucidate the next chapter? Either path chosen, the decision and the stage are yours to command. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.